welcome. I'm Marianne Fisher with CPA.com, and I'm very much looking forward to our discussion today on crypto asset reporting and the impact that this will have on our upcoming tax season. This could not be a timelier discussion, as we know many firms are currently in preparation mode getting ready for the 2020 tax season, and we know that crypto assets will be playing a big role. I want to welcome in my guest for our discussion today, Roger Brown from Lukka. It's an honor to speak with Roger as he brings in a wealth of knowledge and expertise on crypto asset reporting, and I very much look forward to hearing his insights and sharing his perspective with our audience. Roger, I'd like to give you an opportunity to introduce yourself.
Hi, good morning, good afternoon, wherever you are. Roger Brown, Head of Tax and Regulatory Affairs for Lukka. We're a data and software company specializing in the digital asset ecosystem. I have been a lawyer for 28 years. Almost all of those have been in international tax and financial products. About a decade with the IRS National Office, writing tax laws and advising field examiners. And then as a partner in other law and accounting firms, and now have an opportunity to go in-house and have many other new challenges.
Excellent. I thank you, Roger, for sharing your expertise today. I want to start our conversation, Roger, really around kind of the current state of tax guidance. And if you can, I'd like you to kind of describe what is our current state of tax guidance, especially around crypto assets in 2020. And what does today's tax landscape look like, and how is it impacting our accounting profession?
Great question. It's hard to think of an asset class that has grown as quickly as crypto and been embraced by so many people in recent or distant memory. The embraces come from everyday individuals as well as institutional investors in just a matter of years. The IRS has been slow to publish guidance and has only published guidance in the form of general principles that are non-binding due to the way the guidance was published. Following the guidance can sometimes lead to results that do not take into account specifics of particular transactions. The nuances can have real consequences that affect the amount of tax a taxpayer actually pays. The practical impact is that a tax practitioner needs to understand the IRS's published positions and determine whether the guidance is appropriate for the client's particular facts. That analysis is critical, or the client may end up paying the wrong amount of tax in non-vanilla transactions. Unlike other categories of assets, information reporting, i.e. Form 1099s, is largely broken for transactions involving virtual currency. Vanilla transactions can also be impacted, such as forks. Consider the Bitcoin Cash fork that happened in 2017. The price of Bitcoin Cash around August 17, 2017 was about $450. Coinbase allowed transacting in it several months later on December 19th, 2017. The highest price on that date was about $2,900. Since the IRS position is that the fork is taxable on the date it occurs, the taxpayer have an ordinary income inclusion of $458 with about a $2,400 capital gain if they sold it later in December. Those consequences are very different than that had the taxpayer just had an ordinary income inclusion of $2,400 when the taxpayer had dominion and control over the asset, which is a key concept in determining the timing of when income is taken into account. The results would have been very different if the market movement had been opposite and the price of Bitcoin Cash diminished below $458. Then the taxpayer would have had an ordinary income inclusion that couldn't have been offset by a capital loss. Very economically inefficient. And finally, other challenges arise from the fact that the IRS is reconsidering its position as it learns more about the digital asset ecosystem and thinks about how to apply established principles to the new asset class.
Roger, that's an excellent summary. And it really, you hit on like the capital gains aspect, and that really kind of summarizes for us why the IRS is getting involved and why they're kind of making their stamp per se. And that kind of drives us into our next part of the discussion around the IRS and the movement that the IRS has made. So what we're seeing from the IRS is that they have actually moved the virtual currency question to page 1 of the draft 1040 for 2020. What we've been hearing from many CPA professionals and firms is that they're unfamiliar with the tax treatment of these transactions involving this virtual currency. Roger, can you help describe kind of the role the CPA firm plays in addressing this uncertainty and how they can help their clients during this 2020 tax season?
Absolutely. CPA firms are responsible for informing clients of the need to properly report virtual currency to ensure tax compliance on a taxpayer's return. This begins with adding the crypto asset question to the firm's tax organizer. The CPA must then help the taxpayer report all of their holdings and transactions to the CPA firm. There may be transactions of which the taxpayer is unaware, such as airdrops. So the actual exchange files or read-only access may be needed by the accountant, and sometimes may even be encouraged. This will provide protection to the taxpayer as well as the CPA firm. In addition, moving the question to page 1 forces a response on the return, even for tax returns that before were not answering the question because it was on Schedule 1, and not everybody completes Schedule 1. In addition, CPA firms have to address the relevance of prior tax reporting positions, as they may impact current ones to the extent tokens held in 2020 were of the same type held in 2019 and earlier. This is because the accounting method, e.g. FIFO or LIFO, they chose in determining which tokens were sold in 2020 may necessarily reach into positions held in a prior year and which may have not been properly accounted for previously. This compounds the reporting problem by creating tax risk and exposure for the current year while leaving prior tax risk unchanged.
Absolutely. And this really highlights the important role that the CPA firm and our community really plays in helping clients understand the liability and how to stay in compliance in this area. So this is so important. So as firms start to address these tax treatments, Roger, of crypto assets with their clients, what challenges can we expect to see, as we get into this upcoming tax season?
As touched upon previously, gathering a complete data set from clients for any current year activity, point 1. Next, ascertain whether there are any pre-2020 tax exposures relating to underreporting for crypto. Thirdly, decide how to treat any past exposures by A, filing amended returns, B, leave prior reporting positions intact if the client decides not to file an amended return, which there's no legal obligation to do. 3, decide how to minimize risks. For example, if an airdrop was not included in taxable income in a prior year, treat the taxpayer as having a zero-cost basis in the current year for purposes of determining gain or loss. Perhaps even treat the gain or loss as ordinary or short-term upon disposition, thus not trying to take advantage of any tax rate benefit. Next, apply general guidance on the crypto transaction to specific facts. Make note of any factual differences that warrant departure, and offer the taxpayer tips to helping them gather the data, including ways they may be interacting with crypto for taxable transactions or loss events, such as using crypto in ordinary commercial transactions, which is becoming increasingly common.
Well, this can definitely sound challenging, and I know there's a little bit of fear or how do I do this kind of going around. So I know that our accounting community, we're actively looking for supportive tools and technology to help with this, to kind of simplify this. Can you outline for our audience the role that technology plays in this crypto asset tax reporting, and how our community and how the CPA firms can take advantage of these technologies as they prepare for the 2020 tax season?
Absolutely. Choosing the right tax preparation tool is essential for appropriately serving clients who have engaged in transactions involving cryptocurrency, as professionals have the responsibility to produce accurate statements for their clients. Not all tax tools are created equal. Lukka has done case studies on many of the most popular crypto tax tools and found that the same input data set produced varying results in different tools. Lukka's focus is the accuracy and reliability of our software and the application of tax rules. And we ensure that with SOC 1 Type 2 and SOC 2 Type 2 accreditations, which we have earned for multiple concurrent years. One big suggestion when evaluating crypto tax tools is to look to things like SOC controls. It's the best way to ensure that the software you're using can be relied upon. Separately, the absence of any reference to crypto in a tax code or regulations creates uncertainty in a number of instances as to the tax consequences of different transactions involving crypto. Contributions to entities, wash sales, crypto lending, market to market, when something is ordinary versus capital for character are just a few of the examples where there is a lack of guidance and uncertainty. Look for technology that educates you. As mentioned, there's no reference in the tax code or regulation to crypto. So finding trusted resources to guide you along the way is essential. Lukka realized this, and that's why we created the Lukka Library. It's a non-static online database of tax and accounting issues involving virtual currency. The database is offered for less than $10 per month on LukkaLibrary.com and gives diversified opinions on complex topics surrounding crypto tax, law, and accounting. We cover hundreds of issues in there.
Excellent. That's a good rundown of kind of technology. And technology is there to really help firms tackle this with their clients. As we know, this is it can be a new area, a new space for a lot of these firms as they're as they're coming across these challenges. So lastly, Roger, I would like you, if you can, provide any advice to our community on best practices as they prepare for this upcoming tax season.
Great. I'll just be brief with 3 key points. First is prepare your tax organizers to collect as much information as possible. Next, gain access to knowledge resources such as Lukka Library that provide tax guidance on crypto tax issues. And thirdly, do advanced prep for refining organizers and choosing the right tool.
Excellent advice. And Roger, I want to thank you for sharing your expertise and your knowledge this afternoon with our audience. I know this is a complex topic, and I hope that we were able to set the right expectations going into the upcoming tax year, as well as give our community a little bit of resources and available resources to help with this. 2 things I want to point out before we close. If you're looking for any educational tools, CPA.com and the AICPA offer many different courses, classes, as well as technology options for firms that are looking to gain a little bit more knowledge here in the crypto space before the upcoming tax season. And for anyone that's looking for more information or kind of digging into the topics that Roger and I discussed today, we want to let you know about a webcast we have coming up here on December 15th at 2 p.m., preparing for the 2020 crypto tax reporting and compliance season. You can find that webcast on the CPA.com website, and we welcome you to attend. Roger, thank you again for your time this afternoon and for sharing your expertise. We greatly appreciate it.
My pleasure. Thank you.